Hello, welcome back to our channel. Today I want to share you about accounting statements. What is an accounting statement? An accounting statement is a periodic summary of account activity with a beginning date and an ending date. The most commonly known are checking account statements, usually provide monthly, and brokerage account statements, which are provided monthly or quarterly. Monthly credit card bills are also considered account statements. Understanding account statements. Account statements refer to almost an official summary of an account, wherever the account is held. Insurance companies may provide account statements summarizing paid-in cash values, for example. Statements can be generated for almost any type of account that represent ongoing transactions when funds are repeatedly exchanged. This can include online payment accounts such as PayPal, credit card accounts, brokerage accounts, and savings accounts. Utility companies, as well as telephone and subscription television service providers, usually generate account statements for their customers detailing their usage and any overage during the payment cycle. Such statements typically list debit paid, incoming funds, and credit received by the account holder, and fees associated with maintaining the account. For example, certain types of savings account might incur regular maintenance fees unless a certain minimum balance of funds is maintained in the account. Cable television subscription may include state taxes or other charges that they are included in providing regular service. How account statements are used. Account statements should be scrutinized for accuracy, and historical statements are critical for budgeting. A credit or loan account statements, for example, may show not only the outstanding balance due, but the interest rate charged on that debt and any fees that have been added during the payment cycle. This can include late charge for payments not received by their due date, as well as overdraft fees when the account holders overspend. Your account statements are a window into your finance. The statements may also list financial information that relates to the account holder, such as their credit score or the estimated time it will take to completely pay off a debt via installment payments. Alert and notice to the account holder may also appear on the statements, calling attention to matters with the account that need to be addressed, such unusual charges that should be reviewed and verified. Red flags on account statement. Anomalous item on account statement may be sign the account has been compromised, perhaps took or stolen credit or debit card, or took identity entities who gain access to account information. For example, an account holder or the financial institution may spot a charge for concert tickets or a luxury item that seems out of the ordinary. Account holders may be able to dispute such of outrageous charge and file a claim that they did not make the purchase themselves. Reviewing your account statements as they come in is a good financial habit that can catch these red flags before they become a financial disaster. And then I want to sharing about how to make an accounting statement. How to make accounting statement. First, completing your income statement. Number one, list your income for the period covered by your report. Label your income statement at the top and list the name of your organization and then the period the statement covers. Then enter the total amount of income the organization made during the period. Number two, determine the cost of goods or services you sold. Total the costs associated with the goods and services you sold, including labor, material, and any overhead expenses for your manufacture of goods. In a retail business, your cost of goods would typically one by the cost to purchase item for your inventory. Number three, compute your gross profit. Your gross profit for the period covered by the income statement is the gross revenue minus the direct cost of the goods or services you sold. After you've made this calculation, list the amount in the line below the cost, labeling it gross profit. Number four, provide an itemized list of expenses over the course of the same period. Common operating expenses include employee wage, rent or mortgage payment, office supplies, transportation expenses, and marketing. If you have a significant number of distinct expenses, organize them into categories to keep your income statement simple. And number five, subtract your expenses from your gross profit. Total all of the expenses you list and enter that amount under the list of expenses, labeling it with total expenses. You may want to make this text bold so that it stands out from the list of expenses. If you are making a full color income statement, change the color to red. Then subtract that amount from your gross profit. Second, drafting a statement of retained earnings. Determine the current retained earning balance. The organization retained earning is the amount of money the company has earned that is has not distributed to equity partners or shareholders. This amount accumulated from the date the organization started. On the statement, retained earning, the current retained earning balance goes on the first line of the statement. Number 2, list the net income from your income statement. Below the current retained earning balance on your statement, provide the net income you calculated on your income statements for the same period. This amount may be a negative number if your organization did not produce a net profit. Number 3, subtract any income distributed to shareholders or equity partners. If any of the net income was distributed to shareholder or equity partners, it doesn't count as retained income. On the other hand, if no income was distributed, the entire amount of net income will be added to the retained earning. Number 4, calculated the added amount of retained earning. After you subtract the amount of income you distributed to shareholder or equity partners, add the remaining net income for the period to the total retained earning balance. Report the amount on the final line of your statement of retained earning. Number 3, the third, creating a balance sheet. 1. Format your page into 2 columns. Most balance sheets provide a snapshot of your organization's assets on one side of the page and its liabilities and equity to the other, while you can also put the assets on the top and the liabilities and equity on the bottom. Having them side by side makes it easier to see the balance. Number 2, list assets in the left column. Anything your organization owns is an asset. Assets are typically classified into current assets, fixed assets, and investments. A balance sheet may also have a miscellaneous category for other assets or intangible assets, such as intellectual property rights. Number 3, place liabilities and equity in the right column. Like assets, liabilities are divided into current liabilities and fixed liabilities. The equity the owner have in the organization also goes into this column. Number 4, total assets and liabilities to balance the book. When you've completed your balance sheet, the total value of the organization's assets would be the same as the total value of the organization's liabilities. If the two don't balance, go back and look over the values you've entered to find the mistake. Number 4, the fourth, writing statements of cash flow. Fourth, writing statements of cash flows. 1. Determine the organization cash balance at the end of the previous period. The cash balance you started with at the beginning of the period covered by your financial report is the starting point for your statement of cash flow. Enter this amount of the first line of your statement. Number 2 is the net income from your income statement. Go back to your income statement and find the amount of net profit your organization made during the period covered by your financial report. List this amount below your starting cash balance. Number 3, Group your cash flows into three categories. Generally, all of the cash flow reported in your statement fall into three of the broad categories: operating activities, investing activities, and financing activities. From there, you can list specific cash flow directly in each of those categories. However, most organizations track change more indirectly by adjusting the net income based on change to the account presented by each of the categories. Therefore, adjust the net income to find the cash provided by operating activities. If the organization has assets such as equipment that will be used for more than a year, the depreciation in the asset is added back to the cash balance. Subtract the balance of your account receivable from your cash balance. Then add the balance of your account payable. The result is the net cash provided to your organization by operating activities. Number 5. Repeat the same process for investment and financing activities. Purchases are deducted from your cash balance, while any sales would be added to your cash balance. List these items individually, then total to arrive at your net cash provided by investment activities and your net cash provided by financing activities. Number 6 and last is calculated the cash at end of the period. Take the net cash number for each for the three categories and add or subtract them from the cash balance the organization had at the beginning of the term covered by the report. The result of this calculation is your organization's new cash balance. This is enough for this. This is enough, and thank you for watching this video. See you in the next time, and thank you.